Morning, everybody. Welcome to Hamby's webinar for the appraisal update. We have with us today Kevin Braden, Ron Rekemper. Did I say that correct, Ron?
Kemper, yes.
Len Inokuma?
Yes.
And Dwight Tokuda with
Yes.
us. And they're going to be going over some appraisal updates, some major changes, the new forms they have, and so forth. But first, we want to talk a little bit about Hamby. And we're going to go over, we have some events coming up that we want to talk about. So let me tell you what those are. We have today, obviously, the Appraisal Institute one. And then we have on March 28th, this Saturday, we're doing the Kapuna food boxes that we'll be filling down at the Hawaii Food Bank warehouse. If anybody would like to join, I know they're always looking for help. And then in April, we have coming up a webinar for New Res, non-QM asset qualifier webinar. And then on April 23rd, we'll have the Oahu Lenders Roundtable at the, is it the Nahu? Is that where it's at? Kelly, I think that's what it's, Anaha, sorry, at the Anaha. I've been there, but I live in Maui, so I don't remember the names of places that I don't frequent. So, and with that, I'll turn it over to Kelly. She'll go over some of our sponsors with you guys.
Hello, everyone. Kelly with Freedom Mortgage. I just wanted to also start off this webinar by welcoming the Appraisal Institute. So glad to have you guys. And just wanted to take a moment to acknowledge our Hamby sponsors. We have our platinum sponsors of PennyMac, The Loan Store, Lensure, New Res, Deep Haven, The Kind, the best lending name ever, Remen, and of course, Freedom Mortgage. Our gold sponsors are Finance Factors, Angel Oak, Title Guarantee, Acra Lending, Advantage Credit, Foundation Mortgage, and Home Express. And our silver sponsors, Sierra Pacific Wholesale, Logan Finance, Cardinal Financial, and Arc Home. Just a great big thank you to all our sponsors. We wouldn't be here without you guys.
Okay, so it's 10:03. We have about not quite half the people logged on yet. We'll give it about one more minute. Kevin, do you want to go in and introduce everybody and their background and your background?
Oh yeah, my name is Kevin Braden. I'm a certified residential appraiser. I am a VA approved appraiser, and I am also a board member of Hamby. So working with you guys over there to kind of keep Appraisal Institute and Hamby working together. That's me. And then Ron, if you want to introduce yourself.
My name is Ron Rekemper. I'm a certified residential appraiser. I have the SRA designation and the AIRRS, which is a residential review specialist designation with the Appraisal Institute. Been appraising since I was a junior in high school, been doing it for a long time. Happy to be here. Happy to share this with you folks.
I'm Dwight Tokuda. I'm the residential appraiser at Central Pacific Bank. I've been there for about 14 years or so. I have the AIRS designation. Happy to be here.
I'm Len Inokuma, and I'm a residential appraiser on Maui. Like Ron, I'm a SRA designated appraiser, and I've been doing this for over 25 years. And it was nice to be here. Like Ron, we're former Appraisal Institute presidents, so we enjoy the opportunity to blend the two organizations.
Well, we're so grateful to have you all, and thank you so much for coming. And with that, me and Kelly will go off camera, and we'll let the speaker stay on camera. Kevin, if you want to start your presentation, you may start it.
I'm going to share my screen, and then Ron will get us started.
All right, are we ready? All right, aloha everyone. Thank you. Thanks to the Hawaii Association of Mortgage Brokers for allowing us to tell you about some major changes coming through the appraisal process real soon. It's actually occurring now. The Uniform Appraisal Data Set 3.6 is going to change how properties are described, how risk is evaluated, and how transactions move through underwriting. This is not just a change in the appraisal forms, it's a shift in the way properties are evaluated, how the appraisal inspection is performed, how the data is analyzed and risk assessed. This is a major change in the appraisal reporting. This is not going to affect only appraisers, but will also affect realtors, lenders, and borrowers. It will affect how long it takes for an appraisal inspection. It will take more time and effort to prepare documentation for things like renovations, roofs, flooring, etc., and more details needed from the owners and realtors, and lenders for that point. It will be more of a data upgrade, not just a cosmetic form change. This will all lead to probably longer turn times for appraisals and the loan process. This is why we wanted to get this information out to you lenders. How many of you lenders have heard about this? We just did last week, Kevin and I did a presentation for the Honolulu Board of Realtors Leeward Regional Group. And when I asked that question, I think 1 or 2 hands went up, if that. So we're pretty sure that most people haven't heard about it, but it's actually in process right now. It is currently in production, but not mandatory until November 2026. Kevin will explain more about the timelines and the type of loans that are affected.
Thanks, Ron. So just kind of real quickly, just going over what loans will be affected. So all conventional loans, anything that's going to Fannie Freddie, will be mandatory by November 2nd that they're submitted in the new format. And I'll go over the timeline after this. The FHA will be transitioning, and they are accepting reports now, but they have not announced a mandatory adoption rate. The VA has not made any announcements. They worked with the appraisal form companies to make sure the forms were built to what they would need, but they haven't made any official announcement on when they will be accepting or rolling out this the new forms. And then non-QM, your non-Fannie Freddie, credit unions, portfolio loans, that kind of stuff. That's going to be lender dependent as to when they decide to push forward with it. As far as the release timeline, this is where we're at. We're currently in broad production. And from what I've heard nationwide, there's been probably around 100 appraisals done so far. So it's been a very small amount. And as far as I know, none have been done in Hawaii. They've been mostly in the test markets where the appraisals are a little bit kind of more cookie cutter. The key thing on this is the mandate starts November 2nd. That means any report submitted November 2nd or later will have to be on the new form. So lenders really need to start thinking about it much sooner, because if you're ordering a report 2 weeks before that and you order it on the 2.6 and it's an appraiser that won't do a 3.6 and he misses that November 1st deadline, you're going to be stuck with an appraisal that you can't use. And then they've built in the full retirement is May 3rd, 2027. So they've got about 6 months to clear out the pipeline. So that's all the loans that are currently going through. They'll have 6 months to do revisions and get those through the whole process. So next, Ron will talk a little bit about the history of the current forms and where we're going.
Yeah, the GSE, the government-sponsored enterprises, which are privately held, federally chartered financial institutions created by Congress to increase the flow of credit, particularly housing, agriculture. This is Fannie Mae, Freddie Mac being the most recognizable. The GSEs have been working on this for a few years. The Uniform Data Set was originally introduced in 2011, but more recently they started to redesign the appraisal process back in late 2024. you know, back in the 60s when my dad started, was at First Hawaiian Bank, back then the president came to him and said, "Hey, Ray Kemper, I need you to start an appraisal department." Back then, my dad told me he would take the mortgage loan application, write down a few sales on a 3x5 card, come up with a value, and then approve a loan. Man, things have changed since then. I think the first GSE appraisal forms came out in the 80s. We would fill them out by hand. We'd have our secretaries type them up. And oh man, when we got the dot matrix forms, you had to line them up perfectly and hope that the typewriter would print everything in the right places. In 1993, the original Uniform Residential Appraisal Report came out and evolved into the more recent forms, which we've seen the past 20 years. The Uniform Appraisal Data Set 3.6 will get rid of all those 20-year-old different appraisal forms. We had the URAR, your typical residential form. We had a condo form. We had a 2 to 4 family form, co-ops, 2055 drive-bys. All those forms are going away for the GSE. The process will be different as you enter data into a structured field and then drop boxes. The form will start to ask you specific questions and start to generate a form by requesting specific data. The use of standard abbreviations and defined condition and quality ratings are a move to get more consistent information. A move from form-centric reporting to data-centric reporting with greater standardization and reduced ambiguity. Once completed, the report will look relatively similar, but with more emphasis on the type of property, whether it's a single-family home, condo, or multifamily home. Kevin will kind of go through the inspection process and the level of reporting that will now be required.
Yeah, this is just a quick image of a kind of sample report. This is kind of what they're going to look like when they're finished, and we'll have a link later on that can direct you to the UCDP Fannie Mae website where they have all this information. But basically, everything will have its place in the new reports. There won't be any addendums and that kind of stuff where you're trying to search and find stuff. So for the end user, for loan officers looking at a report, everything's going to be in the same place. So it's going to be much easier for you to find stuff. So as far as the inspection process, this is kind of where we're trying to get kind of a lot of education out to realtors and end users, borrowers on what they're going to expect, because right now when we do an inspection, our reports are very narrative. We might say we have a 3-bed, 2-bath, 2-car with a 2-car attached garage. It's on the golf course with views of the golf course. It's got an updated kitchen and the bathrooms were updated 10 years ago. On the new one, we're really going to be diving in room by room. So the kitchen, when was it updated? Was it fully updated? Was it completely remodeled? Well, each bathroom, we're going room by room on the bathroom update. When was the bathroom updated? Was it fully remodeled? How was it? How long ago? Was it 1 to 5 years, 3 to 5 years? Like basically getting very detailed on a room by room level. We're looking at ceiling heights, ceiling types. As you can see in the kitchen, like I said, kitchens and bathroom, we're looking at that individually. Flooring, we're going to report on the flooring in each room. We have to estimate ceiling heights, and then ceiling types also are categorized. The actual report just has a lot more data that's pulled up front that becomes part of that report. And Ronald, we're really going to focus on the GSEs are really focusing on these UAD condition and quality ratings, which Ron will kind of touch on here.
Yeah, just to let you know, All those condition ratings and the quality ratings are in every appraisal. They'll be in the back of the appraisal and are well defined. You know, one of the more important changes or emphasis on the report requirements that Kevin just explained is the standardization of the condition and quality ratings that have been around for a while since UAD started, but there will be more emphasis on a well-defined condition rating. The condition ratings will already be standardized and defined based on what items were updated and to what extent, like Kevin was saying. More emphasis on the kitchen, bathrooms, flooring, etc. Condition ratings are about the level of maintenance, extent of updates, present of deferred maintenance, and functional utility of the property in terms of the market expectations. It's not about how clean and nice the property is or how nicely staged it is. It is about the condition and the updating. The condition ratings are already in any current appraisal report, like I said, but the GSEs are going to be a lot stricter on how the appraisers report these ratings going forward. The condition rating of a C1 is a brand new, never been lived in, 100% new foundation. Your C2 is like new, entirely remodeled in the past 36 months, down to the studs, no deferred maintenance, little or no physical depreciation, and no repairs required. Could be new, but has been occupied. C3, improvements are well maintained and featured limited physical depreciation due to normal wear and tear. Some components, but not every major building component, may be updated or recently rehabilitated, like your roof, your mechanical systems, flooring, remodeled kitchen and bathrooms. Good condition, but not a complete renovation. Your C4 condition rating improvements feature some deferred maintenance, physical depreciation due to normal wear and tear. The improvements have been adequately maintained and require only minimal repairs. Some of the short-lived components have been replaced, but some are near the end of their physical life expectancy, but still functionally adequate. C5, improvements feature obvious deferred maintenance and are in need of some significant repairs. Some of the building components need repair or updating. The functional utility and overall livability are somewhat diminished due to the condition, but the dwelling remains usable and functional as a residence. The roofs may be worn, but no leaks. Kitchen and bathrooms are functional, but could be in disrepair. C6, that's when we got problems. The improvements have substantial damage or deferred maintenance with deficiencies or defects severe enough to affect the safety, soundness, and structural integrity of the improvements. That's when it really starts to kick in, is when it starts affecting the livability and the safety of the property. The improvements are in need of substantial repairs and rehabilitation, and they're not livable. Those are going to be your condition ratings. Like I said, they're in the back of every appraisal. The GSEs are going to be paying a lot more attention to them. And as we go through our inspection, they'll be asking specific questions about that. Going into the quality ratings are also already standardized, but more emphasis are going to be on them by the GSEs once again. Your Q1, your architecturally designed, exceptional quality, highest quality, unique structures that are designed by architects with detailed plans, exceptional high quality interior, basically a unicorn for the wealthiest. I don't know if we even have any in Hawaii, maybe a few here and there. Your Q2, custom high quality dwellings with this quality are often custom designed for construction on an individual property's owner's site. But dwellings in the quality grade are sometimes found in higher quality developments featuring homes built from individual plans or highly modified and upgraded plans. Features high quality exterior ornamentation, interior finishes, details, workmanship, finishes of generally high or very high quality. We have a few of them in Hawaii in some of the really nicer areas. Your Q3 is going to be above average construction. It's a semi-custom home, of higher quality, built from individual plans and above your standard tract developments. Significant exterior ornamentation, interiors are well finished, workmanship and materials exceed acceptable standards, and many finishes have been upgraded. Your Q4 is going to be your standard production housing, your typical tract homes. Dwellings meet or exceed the typical building codes, but are from standard or slightly modified plans with less fenestration, your windows, doors, and skylights, etc. They'll be mostly stock or builder grade materials with some upgrades. Probably most of your tract homes in the developed subdivisions are going to be your Q4. Your Q5 is going to be basic economy construction, typically economically constructed, basic functionality with plain design and basic floor plans with less windows. The dwellings will meet minimum building codes and are constructed of inexpensive stock materials with limited upgrades. A lot of your typical houses are going to be a Q5. A lot of the single wall homes built back in the day are probably a Q5. Your Q6 are going to be low quality, lower cost, and some are probably not even suitable for year-round occupation. They're older, minimal construction, typically built with simple plans or even without plans, with the lowest cost materials and possibly unskilled labor. Your electrical, plumbing, and other systems would be minimal or non-existent. Probably about 80% of the homes in the Kapolei area would be considered Q4. More of your older areas would be a Q5, and some of your more upgraded areas would be a Q3. Condition is condition and quality is quality. You can have a Q4 house that's in C2 condition. Maybe it's not the best quality house, but it was totally remodeled and in great condition. Or you could have a Q3 that's a C4, C5, because it depends on the condition. It could be of above grade quality, but needs some work. Kevin is up next and will explain some of the defects, damages, and deficiencies that you will need to be concerned with.
Thanks, Ron. And also kind of wanted to point out, so the quality ratings, that's based on the quality of the construction, and those never change. So a single wall house that we have in Hawaii, those are Q5. But even if someone completely remodels it and adds dual wall construction, the original construction is still Q5. So that never changes. Condition changes, quality doesn't. So those are just two kind of things to clarify. So something that they have changed for the new forms is the defects, damages, and deficiencies. And this is just in how we report. So basically, if we call something a C4, that means there's potentially some deferred maintenance. And so those are deficiencies which they expect to be called out in the report. If you say it's C4, well, why is it? If I'm saying the exterior is C4, okay, it's, it was painted 15 years ago, it's got a little deferred maintenance. It's not a big deal, but they still want to say, okay, why is this C4? Okay, here's photos, and they're going to be reviewing photos, so this is why we're calling this property C4. And then as part of that defects, damages, and deficiencies, we're going to report, does this issue affect soundness and structural integrity? Stuff like that, it's going to be no. The answer is no. And then, okay, then what's suggested? You suggest completion, meaning it was unfinished, inspection, repair, or none. So a lot of times there's going to be deficiencies which are just don't affect structural soundness, and they don't require any, there's no suggestion for completion or repair or inspection. And so there's going to be just a lot of that. And in the end of the, and that's done on the exterior, that's done on the garage, that's done per room. And at the end of the report, there's going to be a grid that'll kind of show your defects, damages, and deficiencies, which a lot of time will be none, or it'll be nothing that affects value. They're just in a grid. But from a lender's perspective, if there are defects, damages, and deficiencies that require a, say, further inspection, or they do require repair, it's all going to be in the same place. So from a lender end user perspective, you're going to know exactly where that information is. You don't have to go back into a report trying to find where they had these comments, where were these photos. The photos are going to be right there associated with the defect, deficiency, and damages that are noted in the report. So on that end, I think it's going to make it much easier on the user, on the underwriter, and the lender in general to find that stuff and not have to chase down a lot of information after the fact. So that's just kind of something the GSEs have expanded on in the new report. Next, we can kind of talk about market effects. You know, the four of us, we've all been kind of discussing it. It's hard to say. There's just going to be an adjustment period, probably longer appraisal turn times. We're not sure what kind of pressure there's going to be on appraisal fees. I know Dwight is with one of the local lenders. I don't know, Dwight, if you want to kind of comment on what you're seeing from the lender's side and what you guys are kind of thinking.
To be honest, for most lenders, this thing is probably completely off the radar for now. So, but the way I see it, it's gonna be a lot tougher on an appraiser than on other lenders. Of course, for us lenders, all we have to do is review and make sure the report makes sense. But for the appraiser, it's a lot more work. So in the long run, I think it's gonna be a lot easier for us. Everything's all consolidated in each section. We have to flip through pages. Data's better. The only maybe issue I see is possibly because of the details. I'm not sure how it's going to affect collateral underwriter. Collateral underwriter flags certain things for underwriters, so appraisers might get a lot more revision requests. I'm not sure how that's going to work out. I can see maybe some, like Kevin said, maybe some delays because of the detailed reporting. But overall, I think it'll be a lot easier for us at the end of the day. So for the appraisal, it'll be a lot tougher especially in the transition period.
Yeah, thank you.
Kevin, Kevin, can I chime in with a few
Yes.
things?
Please
So what
do.
I've been seeing is, I've been working with a lot of and talking to a lot of lenders, mainly in the mainland, where they are going through this process. And it seems like, and what I've been noticing is that there's going to be a lot more questions improving some of our adjustments, because, well, now that AI has come into place, they can compare us to huge amounts of data. And what it seems like to me is that the GSEs are wanting us to prove, with data, what kind of adjustments we're making. And it's going to be a lot tougher. And if we don't use some of these tools, we are going to be, I guess, rated against them. So even for us, they want more graphs, they want more, just more data to prove how we're getting these adjustments. A lot of times what they've noticed is people have been making adjustments we've made 30 years ago and just carrying it forward, which it's a hard thing. And I know that you've seen revision requests coming and asking us why is adjustment for X this amount. And for us, everything must be proven, and so we're going to have to use data to figure out these adjustments. And I think to begin with, that's where a lot of the bottleneck is going to come up, and a lot more explanations in our reports. So that's what I'm seeing from my end.
Yeah, all this is we're going to go have an adjustment period as it goes into effect, with probably initial longer appraisal turn times. And we anticipate higher appraisal fees because it's going to take that much more work. You know, a lot of the residential appraisers are older like me. Some are over 65. I'm not. And they're going to retire and stop doing lender work rather than learning this new process, all of which is going to affect turn times and probably fees too. You know, the lenders need to be aware of what's coming so they can prepare for it, prepare their sellers for longer and more detailed inspections. Your borrowers, they got to know that we need this information. When was that roof done? When were the bathrooms updated? When was the kitchen done? And we're going to take longer times at the properties to inspect them. We're going to more time gathering the information and the documents and improvements. And we're just trying to set realistic timelines for the appraisal and the lending process. But in the long term goal is for better risk transparency. You know, it's just going to take more time, and we're not sure. Eventually, it's supposed to make it quicker and easier, but you know, the amount of time that we're going to spend justifying these adjustments, which we've kind of taken for granted that we've been using over time, and we have our justifications, but they're going to want to see that justification. So we're going to have to be updating all that stuff. So it's just gonna it's gonna take time.
Yeah, like I said, it's gonna be a lot tougher with the appraisers than on the lenders.
Poor appraisers. So be
Yeah.
nice to your appraisers. You know, and work with us. We're here to work with you. That's why we want to get the word out that, yeah, we're going to need more documentation. We're going to need to know when these things were done.
I think chime in on the adjustments that Len talked about. The thing is I'm not sure about is how, if collateral underwriter is actually going to flag those things. If collateral underwriter flags the adjustments, then you probably got a lot more revision requests or questions from underwriters. But I'm not exactly sure how that's going to work. For me personally, when I look at the adjustments, I might say that the appraiser didn't include the actual support in the report, but adjustment seems reasonable. As a general guideline, what I'd like to see is if you have comparable sales, what I don't like to see, if your adjusted sales range is wider than your unadjusted range, then there might be something wrong with that analysis somewhere. Another general guideline, I think it doesn't always work, but typically, let's say you have 3 comparable sales and you list them in descending order. After the adjustments, more than likely, the adjusted sale price will fall in the same descending order. Because if comp 3 is superior than comp 1 before the adjustments, it's probably to be superior even after the adjustments. So if I see everything that's flipped around, it might cause some red flags for me. But there's always going to be exceptions. So it doesn't always apply. So again, as far as adjustments, if it's reasonable, I'll typically let it go. But again, I'm not sure how collateral underwriter is going to flag these things. And I think that's the big concern for the appraisers.
Thanks, Dwight. I think I'll stop sharing my screen so we can get back to Lisa, Kathy, and maybe take some questions.
Hi there, everybody. It's Judy Meredith with Hamby. Thank you so much for your presentation. It was unbelievable. We do have a bunch of questions coming towards us. Kathy, do you want to start?
Judy, we lost you for a second. I couldn't hear the last part you said.
Oh, we've got some questions coming forward. Lisa, Kathy, would you like to read them off?
Yeah, sure. The first one I have is from Serena Thomas. Can you give an estimate on what new turn times will likely be ballpark?
That's a tough one because even as we speak, the software companies, not all of them have caught up. They're all doing it different ways. So even for us, it's a matter of us trying to work with different software and work with these different areas of information. And we're trying to do it, but to start off with, we're still working on it on our end. we there's different softwares that offer different different I guess features, and so we're trying to go through that now. So we'll get a better idea as we start doing them. But so far, like I haven't received any orders, and I can say that Ron and Kevin, I don't think you've received any orders yet, right?
No, I think I'm expecting one in the next week or so. But I just offered for one of my clients to do it for new construction because that's going to be the easiest way in to kind of learn it. Is something that there's not a lot of variables on. And I think that's my biggest suggestion for lenders is to really try and get ahead of this, but also be strategic in how you do it, because the more complex a property is, the amount of time it takes to do that appraisal is going to be exponentially longer. So if lenders can kind of be strategic with it and be like, okay, here's kind of more like, let's start in more of the basic tract home areas. Let's, if we're on Oahu, let's start out in, Eva Gentry and try and use some of the more typical properties before we start sending the monster home with, multiple ADUs and stuff to the appraiser. That's, I said that the inspections are going to get exponentially longer for those types of properties, as well as just the time to learn the details in the report.
Yeah, that's a good point.
So I have another question.
Time is probably not going to be around for a little while. But as we go through it, I think we'll get better, and it might even shorten turn times. But we're not seeing that at the beginning.
Next question is from David E. Gay. The new form looks like our 1003 that we changed a while back. With the grading scale, do you think that if a property has a lower total grade, will it affect the recommendation on the appraisal?
I don't think so. I think the quality and condition they're already standardized. They're not going to really change. But they're going to be more emphasis. They're going to be looking at the pictures that we take and go, hey, we see some peeling paint. That's deferred maintenance. You need to address that. The GSEs and the underwriters are going to be looking at these pictures, and it's going to generate more questions about condition and quality.
In the data, as we go from room to room, from bathroom to bathroom, before we could lump all the bathrooms into, all the overall condition into one area. Now you're going to have to do it as you go from each room to each room. So, it's going to be a little more detailed, and I'm sure there's going to be questions because, one bathroom's highly renovated, one's, in original condition. So, there's going to be different areas where the condition ratings will probably be flagged, I would guess.
And I think also something to point out is this is Fannie Freddie. This was built for the whole nation. Something like a Q5, it's like if you read the definition of Q5, it says it may not be suitable for year-round habitation. But Hawaii, it is. It's suitable for year-round but it fits that Q5 definition, but it doesn't, that's our market. It doesn't affect lending on the property. And I think lenders need to be kind of wary. This isn't C5, this is Q5. It's completely different. I know a lot of lenders won't lend on C5, but don't be afraid of Q5. That's just what some of our houses are.
Okay, so I see another question from Marlise Riley. She said, I did not see a value for the preferred location in a building complex, like next to a trash chute or for a better view. Is there a place still for a preferred location?
Yes, all the external factors are factored in. There's separate sections for, site adversities, as based on location. Is this beneficial, neutral, detrimental? Same with views. There can be positive views, negative views. That's all incorporated into the form.
They also ask
change values. This won't change values. The value is what the value is. It's just how we report it and how it's underwritten and looked at by the lenders.
Yeah, I think that's a good point by Ron. You know, people need to understand this doesn't affect what a property is valued at all. This is really just how we're reporting things and what we're expected to do.
And then they also asked, what about an as-is property? I think we need some
That's where they're gonna, the lender or underwriter will request, you know, like Kevin was saying earlier, do they need to do repairs? Do they need to fix certain things before it's acceptable? We do that today even, you know, something the lender will pick up and go, okay, you need to go back and either fix that or make it subject to.
Okay.
Yes, typically the lender will only take an as-is report, but sometimes you might have a health or safety issue, like a broken stairs or something like that, where it has to be repaired. In those cases, we would require the report to be subject to repairs. But generally, all the GCs want is an as-is report.
Right.
And I think maybe she's referring to as-is properties that are in disrepair, that are kind of
Being sold as is, yeah.
being sold as is, that might not be going to the GSEs. A lot of those loans are going to
Right.
other type of lenders, and those are the type of lenders that won't have to go use this report if they don't.
Yes.
Okay. And then Leslie Lewis asked, will there be added liability due to reporting on conditions that may be out of scope for appraiser? Structural soundness, major repairs, something that requires an engineer or contractor to review it.
That's where we'll be requesting more inspections. An appraiser is going to still do the same job that they do. We're not home inspectors. It's what we can see, we can document. It's going to be similar to what we do today, unless it is a safety or soundness issue. That's when they're going to require them to be fixed.
Makes sense. And then Melinda Kasem has a question. Are you seeing areas with declining markets in Oahu specifically? But I think we'd all like to know if you see that anywhere in Hawaii.
I don't know if I'd call them declining markets. Some are slower than others just because it takes a little bit longer to sell and they're not getting above list price. Generally, what I've been seeing is markets are pretty much stable. What are you guys seeing? How's Maui? What do you see?
It's pretty similar here, other than you know, the apartment zone condos. You know, everything else has been pretty stable here. And you know, until we see a true trend, you know, which we haven't seen yet, you know, we're not changing our.
I see on Zillow a lot of home prices coming down. Is that affecting things? Or is it just not selling because the interest rates are high, or do you think that the values are coming down?
Zillow, where's Zillow? We don't know Zillow.
Yeah. I mean, I'm talking about the list prices. Like, so people are listing houses, right? I've seen here in Maui, for instance, a house was listed for 1.2, you know, a year ago, and now it's 900 something thousand. You know,
No, that could be.
yeah,
Because
it could be a lot
you
of
know,
things. I'm seeing a lot of houses dropping 20, 30, $40,000 in list price. I don't know what the appraised value is there, and I'm just curious if you're seeing that the appraised values are coming down any at all in those areas in Maui or Oahu or anywhere for you guys.
Well, I think a lot of areas too, we're looking at two separate markets because you can have one area of the island where the single family homes prices are going up and there's little inventory, and the condo market has been decimated from the raised maintenance fees. So those are, you know, it's like condos can be going down in one area where single families are going up in the same area. So it's kind of a bifurcated market where you're
Well,
looking at.
and you can have condos in the same area, but because of the maintenance fees or the repairs, you know, that building may be going down.
Yeah.
I think it's pretty specific to certain projects.
Yeah, we have to
Absolutely.
assess it, you know, each at, you know, as of the effective date of the appraisal. There's all kinds of things that affect the markets. The rain, the war, you know, that's all gonna play. But you know, we just kind of have to wait and see. And each market is different. You know, vacant land prices in Lahaina have been going up. You know, so it's you know, it all depends. That's probably the best answer.
Makes sense. Then Marlise has another question. In your opinion, do you believe that lenders will require the home inspection reports now with this new system?
Yeah, I don't think that'll change.
But I think that'll help the appraisers too. You know, some of that information we can glean from those reports. But I mean, we're still doing the same inspection. We're just getting into a little bit more detail.
Right.
And then Donna Ching says, will appraisers ask for SRPDSs or will they appraise what they see, quote unquote?
The SRPDS is the seller's disclosure statement in the purchase contract.
Well, we already get the full sales contract.
Yeah.
Mhm.
Yeah, we're required to review the entire contract.
Okay, let's see. We have a few more questions here. How are appraisals going to be completed with the flooding in the North Shore? They're not, would be my guess, until the flooding goes away. But just out of curiosity, is there a plan for that?
I don't think there's a plan, and they'll probably subject to repairs.
Yeah.
Yeah,
I
well,
just
I
did
was
an
just gonna say
appraisal up in Wailua yesterday, and it's pretty bad up there, but the neighborhood I was in wasn't affected. And so you know, it's a refi appraisal. I'm going to make a statement in the report that subject's neighborhood was not affected. So it's going to be pocket by pocket, really.
The lenders are already asking us to put a disclosure whether it's been affected by the floods or not. We're just going to have to wait and see what sales occur after that to see what that effect is going to be.
And I'm worried to see. I'm looking at what insurance companies are gonna do because you know we saw what happened after the fire. So you know I'm guessing that this is probably gonna affect our market too, in that way.
some additional questions would be, so underwriting questions for additional comments. Do you guys think that the new forms will force these to be addressed up front? Or do you think there will still be a lot of questions coming back from underwriting?
I think to begin with, we're gonna probably get more questions, and then it's as we get used to the process, I think it'll ease it a little. But I think to begin with, there's probably gonna be more questions.
I think that's the big unknown is, you know, even like Dwight was saying, they just don't know what collateral underwriter, what it's really going to point out. You know, everything I hear is the Fannie Freddie will be using AI to say, you know, you say something's Q3 quality, but AI can tell you, no, that's Q4, it's a standard track home. And AI can tell the difference in a second. So there could be a lot of revisions where appraisers just are kind of going in their old ways and not really changing. And it's kind of the unknown.
Yeah, one of the areas they're asking us to look at further too is like the market analysis. And, you know, there's no guidelines. So, you know, we don't know if, you know, to what extent and, you know, what kind of questions we might get back. So, you know, it's going to be, we're going to see it happen as it goes.
Is even in the form as you go through it, there's a section you can put in, you know, comps that were considered but not used, so that just can avoid an underwriting question later on. But why didn't you know, it's like it's right there and they'll know right where to find it.
And like I said, I think the collateral underwriter, it's going to be on a case by case basis because it's meant to flag things for underwriting. It's not necessarily a problem. So underwriters may have an idea how to address it immediately. So it depends how they look at the collateral underwriter results. And that's the big question.
It depends on the banks because some banks, instead of trying to answer that themselves, they just send it all to us. So, it really depends on who we're working with.
You're right. I try to protect you guys from some of that stuff.
Yes,
All the conditions are all at the end. They're all in the same section every time too. So if there's multiple rounds of revisions, everyone will see it right in order of how they came through and what was requested. There's no more searching through to see if something was done or not. It's right there.
And that does seem like a positive, Kevin, in regards to the new report. Because I do know now that when the underwriter has a question and the answer is put into the revision in the addendum, sometimes you are hunting around the entire report trying to figure out if it was addressed, how it was addressed, if the complete question was addressed. So I think that's going to be much better. Do you think that the 1 to 6 scale that we're using for the Q's and the C's will improve the consistency in the field, or do you think there's still going to be a lot of interpretation gaps amongst appraisers?
I think it's going to be more consistent. I mean, we're going to be paying more attention to it, and they're defined. They have been for a while. It's just, I think some of the appraisers are not well versed in what those definitions are, which is what we're trying to get out there and to share with the lenders and the realtors. Our realtors are one of the ones that make it a little bit difficult because, most of them say everything is in excellent condition, but it just can't be. So we're going to be relying on the realtors to maybe get more accurate instead of everything being in excellent condition, which is subjective for them, but to us, it's well defined.
And I think something we pointed out when Ron and I did this at the realtor meeting was I ran a report for the active and pendings in that region, and 85% of the properties were excellent or above average. So you can't have 85% of properties be above average.
I think it still involves some subjective areas, and so it's hard. If you go to a house that's partially renovated, at what point do you then flip the switch? But what really does actually help us is if on the back end with our comps, if the comps provide us with enough data, then it always makes it easier. So my advice would be to tell everyone involved from realtors to the more data we can get, the more we can get speed up the process on that end, and we can be more accurate.
And just something I want to point out, because like Ron and I are we're talking to a lot of realtors and we're trying to get the word out to realtors, but I think something for lenders too is a lot of the stuff we do is for refis, and I think it's lenders, brokers trying to, if you're doing a refi, kind of letting your borrower know, hey, this is what's going on. The inspection might take, because realtors are going to do that for us on purchases, but it's kind of on the lender to kind of help explain that in the refi kind of world, because that's not through a realtor. So we're still going to ask those same questions with a borrower on a refi of, okay, yeah, when, did you fully remodel this bathroom? When was it done? So we're going to be spending more time at the house just so they're kind of aware that it's not going to be a super quick inspection like it was before. So.
And my question would also be, obviously with the floods, we are going to have a lot of subject to appraisal coming forward. We're going to have new construction appraisals coming forward, more cost approach, spaces rather than comp approach. So how do you think that's going to affect, construction loans and some of those things that might be coming forward for us here in Oahu?
I'm sorry, I don't understand you. So what are you trying to ask us, Samia?
Meaning that the new reports themselves, are there any additional spaces or things that we should be paying attention to when it comes to the new construction and the subject to appraisals for rehab loans and things like that?
You know, the hard
Are
part
there any
about it is
shortages or cells?
we haven't done any of the reports yet. So, you know, it's hard. We'll get a better knowledge, you know, once we start doing the different types of reports.
Yeah, and the cost approach is still an option in the report, but a lender won't rely on the cost approach. So for
Yeah, and
loans, they still want sales
I mean,
comparison.
Judy, take it from me. I mean, you know, I'm on Maui, and you know, because of the Lahaina fires, cost of construction. I mean, throw a dart on the wall. I mean, if you can even get a contractor to talk to you, you'll find that the costs are all over the place, and you know, it's really tough. I'm having Marshall and Swift teach a class, and even for them, it's you know, it's really difficult when it comes to the cost approach.
Yeah, I don't see a big shift going to the cost approach as your major source of valuation. It's still going to be the sales comparison approach.
Right.
Yeah, absolutely.
What else you guys got? What else you got?
So Donna is asking, has anybody actually completed a 3.6 appraisal yet? And if so, do you know if there's any courses available? Because she's been trying to practice with Appraisal Pro and it's not very good, she says.
Like I
Any
said, I think about 100 have been done nationwide was the last report that I got. So that's a very small number. They're really, I think.
So I don't know. We'll give them a few minutes to join. It's 11 o'clock. So I like
Yeah, I got
16
back
people.
in.
Yeah. So
What you think? Did it help?
I thought it was great. It was very informative. I really enjoyed it and I really appreciate you guys taking the time to do this and let us know what's coming. I am an account executive for a lender, for those of you who don't know. And so I get a lot of questions all the time of stuff like this. So this is good.
Have you heard about all these changes?
I've heard about them, but I haven't really dug into them yet because it's not for me until it's like actively happening. I kind of just keep my eye on things. I used to be an ops manager. It was a little more important back then, but as an account executive in sales, it's a little different now, right?
I think that's kind of what I was saying. I think around July is when we're really expecting to see the majority of this, because I've had a few mainland lenders say they're going more in on kind of in the July summertime period. So
that one question somebody asked, yes, there's a lot of classes out there on what's going on and how things are going to be changing. I think I've done a couple, 3 of them already, and I still need more.
Well, was that an appraiser? I was gonna tell her she can try this software. I mean, a lot of you know all the software is doing it for free. So
yeah, her name's Donna Gutierrez, but she didn't get back online yet. So I don't know if anybody knows her, but she was the one asking about it.
Yeah, she's an appraiser, right?
Yeah, she's an appraiser.
Okay.
We can tell her to join the Appraisal Institute.
Yeah, tell her to join the
Appraisal Institute, we're ahead of it, barely. That's why, you know, the Appraisal Institute, us people here, that's why we're trying to get it out there. We're working with all the lenders that we can and just get the word out there to the lenders, realtors, whoever we can. And of course, you know, you should always use a institute people. And and don't forget, we have our golf tournament coming up.
Right.
With Hamby.
Yeah, I was just about to say that. Yeah, I did miss that in the beginning. I apologize for that, but the golf tournament is August 26th, and on August 25th, we have the Hamby conference and CE classes as well. So we'd like to see everybody out on the 25th and the 26th of August for the golf tournament and the conference. We will all be there. I may even golf this year. Let's see
Oh, nice.
if I sure.
Yeah.
But we
Yeah,
will
I
send
golf once a year.
a recording of the webinar before we got cut off. So we'll send that to everybody. Yeah. So, and oh, I have one question. Sorry, I had another question. She's asking. I missed it. I did not see it. Marley says, will lenders ask to see the seller's real property disclosures or home inspection report?
We always, well, like I said,
I think that's a lender
the
question.
contract.
Not sure how that affects the appraisals.
Well, it should be actually that information should be provided to the appraiser because, like Kevin said,
as a lender, we would always ask to see the property inspection if.
yeah, like I said, like Kevin mentioned, the appraiser has to analyze the contract. So if it's in the contract, yeah, they probably need the information.
As far as the appraisal, the home inspection, that's
Right.
out of our hands. That's not something we ask for, and whether or not the lender is going to require that, that's up to the lender. I just know a lot of them don't want to see it.
Well, I'm getting messages also from everybody that say they're very grateful for the details and they appreciate all the information. So I want to tell you that everybody's very happy about this and very happy that you had the time to share the information with us. And it's 11:05 and I don't see anybody else logging back on or any more questions. So on that note, I'm going to wish everybody a beautiful sunny day. And I hope the sun dries up some of the puddles. So, and have a great weekend. Thank you guys. And we'll see you in April. I mean, in August, if nothing else. And in April, if you're coming to the roundtable in April, I'll be there.
Thanks, Lisa, Kathy.
Good. Thank you.
Thank you, guys.
Thanks, everyone, especially Kevin and Ron.
You're welcome. Bye-bye. Aloha.
Aloha. Ohuiho.
Aloha.